Welcome back to More Fun with Finance. I'm Dr. William Elliott in beautiful uptown Shaker Heights, and tonight we're going to be talking about Chapter 17 material. That's basically the second chapter on capital structure, in which we're going to look at the limits to the use of debt. And so let me jump out of the way and swap the picture for the slide deck here. So this material, again, just like the first chapter, does not flow directly with the reading material out of Ross, Westerfield, Jaffe, Jordan, and Shu. However, it does in general cover this a similar breadth of material, maybe a bit more in depth than is in chapter 17. So we're going to first start with the industry effects here. There are definitely some systemic differences between industries. Degree of operating risk. So what's that mean? What that means is, think about, we talked earlier about operating leverage. What kind of fixed cost structure do we have? How much of our cost structure is fixed? That's going to largely determine our operating risk. Each industry is going to have a slightly different level of operating leverage, and thus a slightly different level of operating risk. So that certainly comes into play. Heavily asset-intensive industries, if we have a manufacturing plant with very expensive equipment, think integrated computer chips, very expensive equipment, and so high fixed operating costs. Marginal costs certainly are there too, but the value of the plant. Think another example would be building aircraft. So there aren't that many large aircraft manufacturers in the world because of the exceedingly high level of fixed costs associated with the engineering, the design, and then the manufacturing of those passenger-carrying aircraft. Other industries have very low operating leverage and thus very low operating risk. That means that I always think about this in terms of the income statement, right? Because as we have high degrees of fixed costs, less of that revenue at the top flows down through below that cost of goods down into EBIT or EBT. So we're concerned about that when it comes to debt and the ability to pay and service that debt. Another situation that varies across industries are non-debt tax shields. Okay. So the example written out here in the slide is you've got depreciation. You might have tax credits. There may be operating tax loss carry forwards. These things all reduce the tax bill, but they are not a reduction due to interest costs. And if this reduces our tax bill down to close to zero, then the addition of interest costs does us no good. So we don't get the benefit of shielding our income from taxes as a result of the interest. So for industries, rather, that have very high non-debt tax shelters or tax shields are not good candidates for a lot of debt. And then finally, the ability to support the borrowing, or the ability of the assets to support the borrowing. If the assets are fairly low risk, if they are widely traded, if the value of those assets is fairly stable, not much volatility in it, then they make good collateral. If they're very specialized or have a wide-ranging variability in value from time to time, then they don't make such good collateral. So industry effects can have a large role to play in the amount of debt and the ability to raise additional debt for a particular firm within that industry. So that's something to take account of for sure. There are also individual firm effects, and we're going to get to that. First, let's talk a little bit about the bond rating or debt rating agencies. The three largest and most commonly used are Moody's, Standard and Poor's, and Fitch. But then, as this slide notates, there's Duff and Phelps, Dun and Bradstreet, among others. So the interesting thing about debt ratings and bond ratings is that it's the issuer that pays Moody's or Standard and Poor's to actually rate these security issues. So, in some weird, perverse sense, the rating agencies are actually somewhat beholden to the issuer as opposed to the buyer of that debt, the lender, right? And that created some problems back in the financial crisis. Bond rating agencies knew where they were getting their revenues. The other problem it creates is that the issuing firm, the borrower, can actually shop around, right? If they don't like the rating that Moody's gave them, run over to Standard & Poor's or go over to Fitch and see if we can't get a better rating. So it is problematic. There's no easy fix for this. And, let me just flip to the rating slide here so you can get some sense of how these three major rating agencies view debt. The gold standard is up here. Moody's, it's basically AAA. Same thing with S&P, same thing with Fitch. But as we go down, they change the nomenclature a little bit. With Moody's, we add some numbers, so AA1, AA2, AA3, A1, A2, A3, and then BAA1, 2, and 3. Below this red line here, though, we go from what's known as investment grade debt or ratings down into what's known as junk bonds. So these are extraordinarily risky, and there are a number of potential investors who are required not to purchase. They're disallowed from purchasing or holding any junk bonds. So particular financial institutions cannot hold below the BAA3. These are just not safe enough, and government regulations have prevent them from holding them. So the liquidity of these guys is called into question. But above this, certainly the higher you are, the safer the debt is, the less likely financial distress, and the more likely you're going to not only get your interest back, but also your principal. Obviously, also the coupon payments, the required rate of return on them is a function of the rating, and the higher the rating, the lower the required rate of return, the lower the coupon rate on a particular bond. All right, so let's get into choosing a bond rating objective. The choice of that rating objective involves a decision about the chances of financial distress and the desire to maintain access to capital markets. So it's not just financial distress, but suppose that I'm on the verge of financial distress. I run out of options if I want to refinance something or if I've got a new project. So it's a balancing act between both of these things. And it's also, we bring into play some sort of slack in the ability to borrow in the future if a particularly high MPV project comes along. So this margin of safety is an important element too that we want to consider. So we're going to address all of these things shortly. It's more than just quantitative factors. Part of it is things such as market position. Are they the leader in the market? Are they number two, or are they third or fourth? What sort of concentration is there too? The number one market position, how much of the market do they hold? Is it a big chunk of the market? Is it 50, 60% of the market? Or is it a much smaller piece of the market? What's the management team like? Do they have a track record of managing the company properly, keeping it well into high bond ratings and a very secure firm? Or don't they have a track record? Or maybe their track record is bad. One last thing to mention here. In terms of over time, how has the firm done, or how's the management team done? So it's not just a snapshot in time. We're going to look back. We're going to look at that track record. Okay, so operating risk, we already mentioned that. Market position. What about profitability? What sort of profit margin do they have relative to their peers in the industry? Again, are they leading in that realm? Do they have some unique products that allow them to price at a premium, or are they basically selling a commodity? We already mentioned management quality, conservatism of accounting principles. That's a little more tricky one to delve into, but accounting is a art in many senses. How am I going to account for a particular transaction? There may be multiple ways to do that, and it depends upon what the management's desire is as to whether we take the most radical approach or whether we are much more conservative with our approach to accounting and minimizing the tax burden. And then fixed charge coverage. So fixed charges include interest, but they also include things that like insurance premiums, leases, any regularly occurring charge that the company is required to pay. Comes under this fixed charge. So it's not just interest coverage that we're interested in. We want to look at all the other fixed charge obligations that the company has on a monthly or a quarterly basis. Oops, sorry. And then finally, a couple of additional things. What's the current leverage? What's the adequacy of the cash flows that the firm is generating? And then the future financial flexibility. What sort of CapEx plans do we have in the future? Is it a company that's growing leaps and bounds and has a lot of additional CapEx, which will probably require some debt? Or is it a company that's in kind of the more mature stage and is just replacing an existing issue? Okay, we're going to look at each one of these things individually here. So ability to service the debt, ability to fully utilize the tax shields, protection against illiquidity, desired degree of access to the capital markets in the future, and then some sort of analysis of the dynamics of economic conditions, debt management over time historically, and then transaction costs. So, ability to service the debt. We've got several measures that we could use here. As I mentioned earlier, this fixed charge coverage ratio includes all other fixed charges that the firm is obligated to make in addition to interest coverage. So obviously we want to look at interest coverage, but that's only a part of the picture. Debt service coverage, basically that differs from interest coverage in that the debt service coverage is not only just the interest payment, but it includes any principal repayments, sinking funds, things of that nature. So all three of these together, it's very important to look at all three of them rather than just any one individual ratio. Each one of them gives us a little more nuanced picture of the entire firm and their ability to support additional debt. Here, an example of this would be, say we've got Pateris LTC has 40 million in EBIT, 27 million in interest. So we can compute their interest coverage ratio, simply 40 over 27, or 1.48. Now, suppose they do a bond issue, but they're not going to use that funding immediately. So they do this $80 million bond issue with an 8% coupon, And for the moment, they're going to park it in securities that earn 5%. So that could be preferred stock, could be some sort of money market, something relatively safe. When they do that, how do we calculate their interest coverage ratio? In that case, we still have the 40, obviously, but then we have the additional income generated off of the newly issued $80 million at 5%. And then we scale that by the 27 plus the additional 8% on the 80 million, and we come up with a slightly reduced interest coverage ratio. But again, as I mentioned earlier, we would not only look at that. We would also want to look at the fixed coverage ratio and the debt service, their ability to service all of the debt, interest and principal. So what's the ability to use the interest tax shields? The principal advantage of debt is that we shield some of our income from taxes, so our after-tax cost of debt is considerably lower. 1 minus the tax rate times that coupon rate is what we get for an after-tax cost of debt. So if that firm has a number of non-interest tax shields, to what degree are they going to be able to use the interest tax shield? If they still have considerable EBT after they've taken account of all of the other shields, depreciation, things of that nature, amortization, any tax loss carry forwards, then okay, not a problem. They can use it. If they don't, well, then that cost, the effective cost of that debt goes up and up and up towards the coupon rate. I should also add that those shields, even though we could conceivably push them out into the future, doesn't mean that the value of those things is maximized. So anytime we move something out into the future, we lose value because the present value of that is much less. Already talked about that. The ability of the assets to support debt. Here we're talking about collateral, right? The collateral value of the asset. Does it have a low risk? Is its value stable across time? That would make a very good collateral. If it isn't, then that makes not such a good collateral. So again, some of that could be industry dependent. Some of it could be firm dependent, depending upon the firm. You could obviously you can replace labor with mechanics, some sort of assets, and to the degree that one firm uses labor, the other firm uses machinery. The latter firm would probably have more collateral that would support additional debt, whereas the former would not. Okay, this thing about access to capital markets in the future, that's a really important one. And this one, the research tends to support the idea that while firms understand that their optimal capital structure might be a bit higher, they hold back a little bit. They don't quite issue all of that debt, with the idea that there may be a project in the future that we're going to need that debt for. And if we issue it all now, we're pretty much maxed out. And how else are we going to fund any future projects? Well, we could issue equity. There's no question about that. But as we talked about with the pecking order idea, if we issue equity, we're giving away some of those gains on that new project to other equity stakeholders, the new equity, as opposed to the existing shareholders. The new shareholders get some benefit out of this too, and the old shareholders lose. So there's always this tendency to hold back a little bit. Don't bring it up to the full level of debt that we can support simply because we can. Maybe we need it for a future project. Another reason for holding back a little bit was suppose that maybe we have some cash flow problems. and we're not as able to support our interest payments. Not that we go into financial distress, not that we miss an interest payment, just simply that our ratios start to look a little worse, and the bond rating agencies are regularly looking at firms, and they might downgrade a particular issue. So we also want to be cognizant of that. How does the firm manage its debt over time? A firm might deviate from the optimal pecking order method. Remember, pecking order says we're going to first fund something with internally generated funds. If we can't use that, or if we don't have enough to fund the project, then we're going to go to debt. And if we can't use that, we might go to something like convertible debt. And if we can't use that, then and only then will we go to an equity issue. So here's another situation though. Suppose we just need a little extra capital. Well, one thing would be to go to the bond market and do a full-blown bond issue with the associated high fixed costs. But what are we going to do with the rest of the money? Well, we might have to park it somewhere. What's the opportunity cost of parking that money? We're probably not going to get the sufficient return to cover the interest on it. So another alternative that many firms use is that in the short term, where they need small amounts of capital, they may go to a bank line of credit or even short-term debt, and then build up that pile of line of credit or short-term debt to the point where then later it makes sense to do a large bond issue, bring the rate back down, and sometimes that's a more sensible alternative. How do we choose our optimal capital structure? Well, comparative credit analysis says, why don't we just look at other firms? Look at peer firms, comparable or comparable firms, and look at all of their ratios, compare them to our ratios, look at their credit rating, and if we can make our ratios match their ratios on a variety of parameters, then presumably our credit rating should approach theirs. Now, one thing I didn't mention when I talked about Moody's, Standard & Poor's, and Fitch is that they have models. And those models take a bunch of factors, put them into the model with a bunch of data from each firm, and out pops a credit rating. It's not quite that easy, but you get the general gist of it. Well, these things are secret. They are proprietary. Nobody's going to reveal what that metric is or that model is, because if we did, then there's an opportunity to game the system. So this comparative credit analysis is kind of the next best way of reverse engineering a credit rating. We'll look at, obviously, all of our the items that we've talked about before: ability to service debt, ability to utilize the tax shields, and protection against illiquidity. Illiquidity being a decline in cash flow, where we might not be able to service the interest payments. Oh, sorry. I should have removed the animations on here. So this comparative credit analysis, we select the comparative firms or the comparable firms and dig through all of the ratios that we think the credit rating agencies are going to be using. For instance, profitability. We've got operating profit, net profit margin, return on assets, return on equity. We have short-term debt, senior, long-term, subordinated debt, and equity in terms of the capital structure. We have the various leverage ratios. Oops, went the wrong way there. Liquidity ratios, current ratio, maybe even the quick ratio. Fixed charge coverage for the current year as well as prior years. Look at any trends that might be revealed, and do the comparative analysis on those particular measures. Finally, pro forma analysis gives us the ability, just like when we were talking in chapter 3, I believe it was at the beginning of a class, about pro forma financial statements. Well, this is basically the same thing. We're going to create and project out into the future what our financials will look like. That's what the credit rating agency will do too. That's their goal, is to see what's it going to look like in the future. Because remember, a credit rating agency that tells you the credit worthiness of a firm is gone down after it's already gone down isn't a whole heck of a lot of help to us. Not saying that that doesn't happen. Actually, it did happen during the financial crisis. You would see Moody's downgrade a particular issue of a company, or the entire, all of the issues of a single company, but the value of their securities had already plummeted. Of course, that was a very fast-moving market, a lot of interconnected pieces that we weren't aware of here prior to the financial crisis. So I guess we can give them a pass on that. But the whole idea is that we're trying to predict this as opposed to just shut the door after the horse has already left the barn. That's not a whole lot of help. So here again, we're going to focus on things like ability to service the debt, use the tax shields, coverage ratios, future CapEx projects, and then even things such as payback policy to the shareholders, either through dividends or through repurchases. Obviously, the dividends is a little stickier because a repurchase we can easily forego. Nothing happens to us. If we forego a dividend, really bad majumba happens to us. Really bad things happen to us if we forego a dividend. That's a signal to the marketplace that the company is in dire straits. Some scenario analysis comes into play here too. So it's that whole idea that we looked at in, I believe it was chapter 7, looking at scenario and sensitivity analysis to get some idea of how close to the margin we are. And then finally, the firm can issue new securities, new bonds increase leverage, new common shares decrease leverage. Other methods to attain changes to the capital structure: an exchange offer. So we might use a equity issue, use the proceeds from that to buy back some debt. Right? That would lower our leverage. We could do the reverse, actually. Recapitalization of existing securities, debt or share repurchases, and then, as I mentioned, stock for debt swaps. And that pretty much brings us to the end of the material out of Chapter 7. As I said, this is a little more in depth than, Chapter 17. This is, let me just start that over. This brings us to the end of our discussion about the material in Chapter 17. As I said at the beginning, this is a little more in depth than Chapter 17 out of Ross, Westerfield, Jaffe, Jordan, and Shu, but hopefully it's been helpful to you, and I will see you next time. Have a good evening.